Hey guys, welcome back to my YouTube channel. My name is Chukwuka John, and I'm glad you're able to join me again in this video as I explore in-depthly the concept of financial vehicles and why I think savings shouldn't be your only financial vehicle. So we're going to delve deep into this concept of financial vehicles, and I'm going to make a list of financial vehicles that I think you should consider diversifying your portfolio or what have you. So before I get started, I would like you to do me a favor. If you could go ahead and like this video, go ahead and subscribe to my channel, go ahead and leave a comment. Let me know what you are thinking about the financial videos or the financial independence videos that I've been doing, and that would help me gain more visibility in the YouTube community. So, yeah, let's get down deep into this concept today. So, understanding financial vehicles and why I think saving shouldn't be your only long term strategy. So, at its core, the escape velocity framework helps you to transition your money from more conventional ways of savings into proven investment vehicles. There are lots of investment vehicles out there, but these ones are proven. And by doing that, you are able to accelerate your journey towards your financial independence. So, let's talk about this framework. It emphasizes tested and reliable investment options like real estate and life insurance, and it provides you with a roadmap for you to make informed decision about your wealth. Let me introduce you all to the escape velocity number. It is your financial independence number where your passive income matches your living expenses. Now, to teach you about the escape velocity number, you have to consider the time factor. Every investment is going to take time for you to reach to where you are going. So, irrespective of how you want to travel from New York to London, it's going to take a long time for you to do that. By commercial flights, you are looking at maybe 6 hours to 7 hours of flight. By using a supersonic jet like Concorde, you are looking at maybe 3 to 3.5 hours. By using a cruise ship, the journey might take you 6 to 10 days on the sea. I don't think I want to do that. So, unless you have a windfall from life insurance or some inheritance coming into your account, you have to really plan for your financial independence. There is no way around that, right? And how do you plan? You have to use investment vehicles. You have to use tested, tried investment vehicles that can be able to help you accomplish that goal. So, in planning for your financial goal, the speed of the vehicle matters a lot. So, for example, a person who is running to their goal is faster than the person who is just walking to their goal. And the person who is driving to their goal is always faster than the person who is running to their goal. But guess what? The person who is flying to their goal is faster than the person who is driving to their goal. Remember, leverage matters. So these metaphors illustrate the speed of different investment vehicles relative to you reaching your goal. We are going to go down the list in a moment and where we're going to list out some financial vehicles. And I hope that you are able to see the advantages and disadvantages of some of the investment vehicles out there. So number one, your savings. So your savings is a interest bearing account that most banks will offer or some financial institutions will offer you. Now, what are the advantages of your savings? Number one, you have the ability to withdraw your money at any time. So savings is very liquid. You can withdraw your money at any time and your money is safe. Your money is safe and savings account will always pay you interest. It's going to pay you interest. But what are the disadvantages of savings? It's a very, very low interest returns. Most banks would limit your withdrawal to 6 transactions per month. It's a very slow vehicle to your financial independence. So number two, certificate of deposits, which some people call CD. So these are bank offered timed deposit with a fixed term and interest rate. So assuming the banks want to tie up your money for 6 months or 12 months for a 3% or 4% return. So what are the advantages of CD? They are principal protection, and they guarantee your money. Your money is guaranteed. There is there is safety, and there is liquidity of your money. It's a very low risk investment, right? So you have access to your money after the period is over. What are the disadvantages? It's a very low return type of investment, and then your money is tied up for the term of the maturity. It may not keep pace with inflation. So number three, we're looking at stock. Stock is the ownership of a company, and you can participate in the company's profit sharing, and be able to vote as a stockholder. Advantages: you have potential for high returns, right? A lot of billionaires have been made in the stock market world. So ownership would help you with the participation and profit sharing in the company. So liquidity: stock can be very liquid. You can sell your stock, your shares at any particular point in time. What are the disadvantages? High volatility. They are pretty high volatile, right? And you can lose your money in a very short term. There are no guaranteed results with stock markets. You could titrate and plan for anything that you want to do with the market, but it might not return. And it requires a ton of research. You have to do your research before you buy into a share or a stock of a company. So number four, we're looking at mutual funds. So these are pooled funds that are collected from many investors, and they are now diversified into stocks, bonds, and other securities. What are the advantages? It's a great way for instant diversification. So if you be looking at picking so many stocks, no, just invest in mutual funds, because with that your funds are diversified, and then they can appoint a fund manager to look over your investments. So it's also great for small investors who are just wanting to start out. Disadvantages: it's you lack control of other investments within the fund. So right, if there are several, if it's like S&P 500, you lack control over what stocks are being picked and all that. So number five, universal life insurance. IUL is a type of permanent life insurance that combines a death benefit with a cash value component tied to the performance of a stock market index, right? So it has the death benefit, and then it has the savings component, which is tied to the stock market. So the cash component can grow based on the performance of the stock market, and this is an advantage of IULs, right? It's a tax deferred growth on your contributions and your ability to take a loan from the policy that you have. So you can use your money 2 to 3 times if you really know what you are doing. I'm going to be doing a lot more videos in IUL. So IULs, the disadvantage there is that it is really, really complex. You have to find someone who knows what they are doing to be able to write your policies for you. Another one is there is cap and participation rate, which limits policyholders' participation to avoid your policy becoming a MEC, which is a modified endowment contribution. So IULs come with costs, they come with fees. These are the things that you should know. Let's talk about real estate, which is my favorite. So real estate is the popular investment vehicle which involves investing in physical properties, such as residential homes, commercial buildings, or land, right? Let's look at the advantages of real estate. Real estate has the potential to appreciate in value over a period of time, thereby allowing investors to build equity and potentially realize capital gain from their investments. So investors can borrow money, right, from financial institutions or banks and all that to invest in real estate, right? So potentially amplifying the returns on their capital. It's a great way. Leverage, like I said before, leverage is the way to go if you want to achieve financial independence. So real estate is also a hedge against inflation. It can act as a hedge against inflation. You can raise your rental income as inflation is increasing, thereby acting as a hedge for you against inflation. Real estate is a great way to save on taxes, right? With the mortgage interest deductions, the property deductions, and the depreciation allowance. So there are great benefits with real estate. I'm going to be doing a lot more videos about real estate. What are the disadvantages? Disadvantages: well, real estate is very illiquid, right? So once you invest your money, you cannot withdraw your money like your savings account. You can't withdraw your money like your stock and all that, right? Your money is fixed in there until you sell the property. So there is significant amount of money when it comes to real estate. You have to talk about taxes, closing costs, down payments, and all that. So what is another disadvantage? Real estate can be impacted by the changes in the tax laws, changes in financing, changes in interest rates, that can affect real estate. And then there is the problem of vacancy, right? So some of your rental properties might hit at some months, might not be performing as you want it to perform, right? Because there is vacancy in that particular property. So so I've listed a lot of financial vehicles. I've listed real estate, I've listed certificates of deposit, I've listed savings, I have also listed mutual funds. Right. These are different vehicles that I need you to go research, right, on how to start investing in these vehicles. Savings shouldn't only be your vehicle, right? Because savings is good, but the returns are not that great compared to investment vehicles like IULs or investment vehicles like real estate. So you have to sit down. This has to be a decision you make within yourself. People on YouTube, people on Facebook or other social media can only talk, they can only recommend, but the escape velocity framework has to be very particular to you. You have to be the person who sits down to say, this and this and this is what I am comfortable with. But if you ask for my recommendation, I would say if I were to start up my investment journey all over again, I will first of all start up with IULs and then go into real estate. And I have my reasons for this path. So let me explain what I meant by that. Assuming I have 100,000 in my cash value life insurance policy and I go and borrow 40,000 from that. So with cash value life insurance policy, I can still earn interest based on the 100,000 and not the current value of 60,000. So it's a very, very powerful tool, and I can decide to either pay back the 40,000 or not pay it back, right? Because it's my money that I put in there. So a lot of people have used IULs as great investment vehicles in the past. You have awesome possibility of using your money 2 to 3 times. And then I use that money and invest in real estate, right? So when real estate is making monthly cash flow, it's giving me 4 to 5 thousand on on monthly basis. I can now use that cash flow to pay back my IUL, right? So this is a path I would follow if I were to start all over again with investments. But your path might be different. You might decide to go into stock. You might decide to go into mutual funds. Everybody, there is a recommendation out there that you must have to be diversified, right? So diversify, put a little bit to mutual funds, see how it performs. Put a little bit to IULs, see how it performs. Then put majority of your money into real estate, because real estate over time will return great investments back to you. So thank you for watching this video today. I hope this has been very informational to you. I hope you've learned about different financial vehicles and how they can help you accomplish your financial independence, and more importantly, the speed accustomed to each financial vehicle. So I implore you to make a wise decision. Choose investment vehicles that have been tested and tried over time and have made a lot of people financially independent. Thank you for watching. I hope to see you here next time. Bye.